Hey everyone, welcome back to the channel. Today, we're diving into a super common investing mistake that costs Americans, and really people everywhere, thousands upon thousands of dollars, something that sneaks up on even smart investors, so you'll definitely want to stick around for this. So, what is this costly mistake? It's trying to time the market. I know, it sounds so tempting. The idea is simple. Buy stocks when they at their absolute bottom and sell them right at their peak. If you could do that perfectly, you'd be incredibly wealthy. But here is the hard truth. Nobody can consistently predict the market's highs and lows. Not the experts on TV, not your brilliant cousin, not even sophisticated computer algorithms. Let me break down why this is such a financial trap. Markets are driven by countless unpredictable factors, from global news to investor emotions. Trying to guess the exact day to jump in or out is more like gambling than investing. People who try to time the market often end up doing the exact opposite of what they intend. They panic and sell when the market dips, locking in their losses. Then they wait too long to get back in, missing the best recovery days. Research from major financial institutions consistently shows this. For example, if you stayed fully invested in the S&P 500 over the last 20 years, your returns would be significantly higher than someone who missed just the 10 best performing days. Those best days often happen right after the worst days, which is exactly when most people are too scared to invest. Missing out on that rebound is what truly decimates your long-term growth. Imagine your portfolio growing steadily, but by trying to be clever, you accidentally skip the biggest growth spurts. That's tens or even hundreds of thousands of dollars lost over a lifetime. So, what's the smarter approach? It's a strategy that is far less stressful and way more effective. Time in the market, not timing the market. This means investing consistently over a long period, regardless of the daily market noise. A great way to do this is through dollar cost averaging. You invest a fixed amount of money at regular intervals, say every month. When the market is down, your fixed amount buys more shares. When it's up, it buys fewer. Over time, this averages out your purchase price and reduces the risk of buying everything at a peak. It's an automated, disciplined approach that removes emotion from the equation. Instead of stressing about daily charts, focus on building a diversified portfolio of quality assets that align with your long-term goals. Let compounding do its magic. It's the patient investor, not the frantic trader, who truly builds wealth. So, forget the crystal ball. Stay invested, stay consistent, and watch your money grow over time. Thanks for watching, and if you found this helpful, be sure to hit that like button and subscribe for more content to help you invest smarter. See you in the next video.